Hello and welcome to the quarterly performance segment of Making Sense of Markets, Q4 2017. My name is Sheldon McFarland and I serve as the Vice President of Portfolio Strategy and Research at Loring Ward, and I'll be your host for this segment. Let's begin our quarterly performance discussion by visiting two major themes that played a part in 2017 performance: low volatility and a declining dollar. A good way to frame the low volatility discussion is by looking at a volatility index like the VIX, which measures the expected volatility of the S&P 500 index. The S&P 500 index being a representation of the U.S. stock market. In 2017, the U.S. stock market was at its most docile in living memory. The VIX saw 22 of its lowest 25 readings ever in 2017. Throughout almost the entire year, realized monthly volatility was at its lowest in at least a decade. Another way to frame our discussion of market calmness is to look at historical maximum drawdowns for the S&P 500 index. Looking at the average maximum annual drawdown each year since 1980, we see that recent drawdowns have been well below the historical average, represented by the green line there on the screen, of negative 9.22%. This low volatility has been accompanied by an upward trend, with the index hitting 66 new highs since November 22nd of 2016. This upward trend can be seen by looking at the monthly performance of the index. 2017 was the first year the index did not experience a negative return month. This was the first time on record that the S&P 500 has risen every month during a calendar year since 1926, the beginning of the index data. Yes, recent volatility has been low, and if future volatility were to spike some, it shouldn't be worrisome to investors as we are currently below what we would consider normal levels. Next, a declining dollar was a 2017 trend that provided a tailwind for international investment performance. For the year, the dollar finished down roughly negative 8.6%, even as the Federal Reserve raised rates. Investors appeared more bullish on economic recoveries in Europe and other parts of the developing world, and considered a possible slowdown in the U.S. The change in the dollar will impact the value of your international investments. International investment performance has benefited in recent quarters from the dollar declining. However, in prior years, there's been a negative impact from the dollar strengthening and thus hurting international returns. Much like stock markets in general, nobody can predict which way markets will go next, but having exposure to a variety of currencies within a portfolio can provide an additional layer of diversification. The return on international stocks can be thought of having two components. The first being the return of the stocks in their own local exchange, say London, Frankfurt, or Tokyo in their local currency. The second component is the currency impact. When the US dollar declines in value, those foreign stocks denominated in other currencies are now worth more when converted back into dollars. We can see this impact for 2017. An index of international stocks gained 14.6% on their local exchanges, but also benefit from the dollar declining by 9.6%, meaning the overall gain for the quarter to a US investor was positive 24.2%. Let's now look at a macro view of fourth quarter performance around the globe. Returns often differ in stock markets around the world, and this quarter was no exception. A snapshot of performance for the first quarter shows that returns were positive in North America, but even higher in other regions around the world, partly due to a declining dollar, which fell negative 0.7% during the quarter. Returns in US dollars for the quarter look something like this. Most major regions produced a positive return for the quarter, while Latin America was the exception, returning negative 2.3%. Elsewhere, Asia was the strongest performing region for the quarter, gaining 8.3%, followed by North America and Europe, Middle East, and Africa returning 6.3% and 2.2% respectively. In general, during the quarter, we saw positive results for most asset classes. While large growth stocks led the way in the US, small growth stocks were the top performers in international markets. Looking back over the last 15 years, we see a similar trend, both US and international stock markets rewarding investors who stayed invested, specifically in the small and value segments. In the US, a tilt towards small company stocks versus large company stocks rewarded investors with a 15-year annual premium of 1% on average. However, investors tilted towards value versus growth have experienced relative annual underperformance of about negative 0.7% on average. International investors tilted towards small and value stocks captured average annual premiums of 4.2% and 0.3% respectively. In general, investors who stayed invested and followed our strategy of tilting their portfolios towards small cap and value companies both in the US and international allocations of their portfolios were rewarded with higher returns than a non-tilted portfolio over this period. Looking at the most recent quarter's asset class returns, we see asset classes in your portfolio ranging from positive 6.8% for emerging markets value on the high end to negative 0.2% for U.S. short-term bonds on the low end. Maintaining a diversified asset mix, such as a 65% stock, 35% bond mix shown in white, kept you away from the more extreme returns from year to year with significantly less volatility over the last 15 years, highlighting the importance of maintaining a well-diversified mix of asset classes in your portfolio. On this slide, we look at the absolute impact of different asset classes on a sample index mix of 65% stocks and 35% cash and bonds. We can see that the largest impacts to performance were driven by international large value stocks, U.S. large cap stocks, international small cap stocks, and U.S. small cap stocks. The overall gain on this index mix for the fourth quarter was 3.35%. Robust growth rates and synchronized global growth fueled much of the gains in 2017. All 45 countries tracked by the Organization for Economic Cooperation and Development are on track to grow this year, and 33 of them are poised to accelerate from a year ago, according to the OECD. It is the first time since 2007 that all are growing, and the most countries in acceleration since 2010. In the past 50 years, simultaneous growth among all of the OECD-tracked countries has been rare. In addition to happening last decade, it has only happened in the late 1980s and for a few years before the 1973 oil crisis. With much of the growth being priced into the markets, we don't know if that will translate into another double-digit year this year. However, as our charts indicates, from a global growth perspective, the outlook is positive. Growth projections, although decelerating, indicate continued growth. This concludes our presentation for today. Thank you for joining me. Until next quarter, goodbye. To view this or past commentary, please see Making Sense of Markets portion of Loring Ward's YouTube channel.